When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Fogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Fogan. And now here's Jeff Fogan and Jeff Shea.
Thank you so much. Welcome to Premier Retirement with Jeff Fogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about current events. We'll also answer some listener questions. And then finally, estate planning for the great wealth transfer. Protect your legacy. Not Uncle Sam's. My name's Jeff Shadis. I'm just here to ask the questions, but of course, the words of wisdom and solid advice that come from the other Jeff, the one that counts. It's Jeff Fogan, founder and president of Premier Retirement Planning and Wealth Management. Jeff, how you doing this weekend?
Doing great. It's always fun to be here with you and the listeners. Looking forward to a good show.
Yeah, we got a lot to talk about on today's show. I can't remember when we've had as much to talk about in terms of geopolitical events, what's going on around the world and in this country, as we have this past week. Of course, everyone knows the conflict between Iran and Israel and our bombing of the Iranian nuclear facilities and everything else that seems to be going on. But despite everything going on in the world, Jeff, the markets are really surprising me because they're still good. The S&P is touching a record. I guess the question is, are the markets being too sanguine? Are they being too complacent? Or are they just rightfully sort of taking this wait-and-see approach?
Well, I think, the complacency and just the lack of worry, considering all the things that should be affecting the market, is a little bit concerning. I think the complacency is usually what happens before the next big market crash. Of course, we've been talking about that because the complacency has definitely been a big part of the market the last couple of years. They just keep on cheerleading it and say, oh, well, it always goes up. The thing is kind of funny. They're talking about, oh, it's knocking at the door of an all-time high. Well, that all-time high happened almost 7 months ago, so we're finally going to make money again. So people in the stock market probably haven't done all that well, in the last 6 or 8 months. People in 401ks, yeah, well, my 401k is growing. Well, that's because you're adding money to it every month. Good for you. You should continue to dollar cost average into it when the market's flat. It's great. I like when the market's flat or down. It means you get to keep buying at the same price, even though I think the prices are a little bit overinflated. We can talk about price earnings ratios and where they should be and where they are and things like that. I'm sure we'll get to that eventually today, but the market has got all kinds of things to look at. You've got World War III on the brink. Hopefully the ceasefire will hold out and we'll be okay there and not add any additional problems to that mix. That was really crazy that some of these hedge fund managers and oil people are saying, oh my gosh, just by that alone, we're going to get the Strait of Hormuz or whatever it is, where they go through all the oil from Iran. They're going to close that and oil's going to go to $150 a barrel. Funny, I just went, I go, crap, I'm going to day trade that. So I jumped in there and I lost $3 a barrel. Like in a minute, I was like, how's it going down? Wait a minute. So let's just rethink this. It really hasn't come to light, but I found out a day or two later researching it. I probably should have known this already, but you just think like, oh, there's these logical things. Everybody and their dog's going to be buying oil. And it was, the layperson was buying it like crazy. And the hedge fund managers, the people that were kind of a little bit more on the front line news, knew better. Now that Trump's in office, we've been able to drill and stockpile oil like we've never stockpiled it before. There's plenty. Trump even said a few days ago on TV that, China can buy oil from Iran. If they want to buy it from us, they can buy us. We got plenty. We got more than we need. And that came out to reiterate what I found out, earlier in the week when we thought oil was going to go to the moon, is that we're a net producer, exporter of oil right now, if we want to be. So we're in a good place. That's certainly a reason to be a little more complacent, like, oh, wow, you know what? Guess what? America's kind of standing on its own 2 feet. We're not so reliant on all these other things that maybe our market does have to worry. So, it's kind of a little awakening to me, to be honest with you. Everybody's like, oh, man, the war, oil, buy oil. And it's already gone up, $8 or $10 a barrel, I think, in the last month or so, just in anticipation of what's been going on in the Middle East. But didn't get any higher, didn't go to 150. I still don't think we'll see it now that we kind of know what the situation is globally with the oil market. And of course, I don't think Iran's in a position to start pushing the issue too much, given the fact that they got a lot of their economy obliterated. And Trump was very nice to say they need money to rebuild. We're not going to tell them they can't sell oil and do stuff. He says those people deserve better. And it's lost a lot of money. From a humanitarian standpoint, it's good that they have money to rebuild as long as they're not in a position to use that money on building nukes to bomb us and Israel. And I think that's certainly starting off on a better footing in the Middle East. I think that could give us a little bit of calm. The thing that still worries me, though, is just how overvalued the market is. It was overvalued when it peaked out in December, just after the election, 6-7 months ago. historically it's still overvalued. If you look at the actual historical price earnings ratios of where they should be, or where they typically average, is somewhere in the 16 range, 16 price earnings ratio, which means somebody's willing to pay $16 for a dollar of earnings. If you look at that from a return standpoint, it's somewhere around 6%, right? So as long as we're making 6%, that's kind of right in the middle. We'll buy a company as long as it can keep growing and growing my earnings, and I can make that on my money. Now, we don't care if the company reinvests that money, because then it makes the stock go up maybe more than 6%, like 10 or 20. So that's why we invest in the stock market. We don't really care that we get those returns, but we still base it on how much is the company making, and is it really a worthwhile investment, and can they reinvest it for a compounding return so the stock market makes sense? Well, again, 16%, that makes a lot more sense than 35, which is where we're at right now. And that is on the current price earnings. But what they've done in the last few years is they're going by forward price earnings. They said, well, yeah, but we expect next year, all these companies are going to make 20 or 30% more because Trump's fixing everything and that inflation is down, so they'll be able to make a lot more. Well, that's not necessarily true. When they were doing that 2 years ago and the market went up 28%, in 2023, the earnings were right around 1%. And last year, they were right around 2%, almost flat both years. Yet we had 20 plus ranges of returns on the stock market, which meant the price earnings ratio went from like 28 to 38. So it got worse. Didn't get better. Why? Because there really weren't earnings, even though they kept on saying, oh, yeah, but next year their earnings are going to be good. Next year their earnings are going to be good. They've been saying the next year's earnings, PE ratios, have been in the low to mid 20s for, a few years now. And I don't remember it being that figure that they were using. They actually used to use, the current this year's price earnings. I mean, they're looking at 2026 price earnings rate expectations, and that's a year and a half away. Not just a year; it's next year. 2026 is what they're claiming will make. Now, what'll happen between now and then is companies will revise their earnings expectations, and they'll lower them and lower and lower them, but they won't be reflected in. They'll still be reflected a year out at 23, and they'll lower their price earnings expectations to like, oh, we think our earnings will grow by 7%. And a good company comes in and they actually grew their earnings by 8%, still not anywhere near the 20% that it ought to be in order to justify a 20 plus price earnings ratio. But they'll come in and they'll say, oh, they surprised, they actually beat their earnings estimates. Well, that's because they already lowered them, so they could beat their earnings estimates. 80% of the companies typically will beat their earnings estimates because they always want to shoot low and surprise high, because it makes their stock go up and people get in that little feeding frenzy and they want to get in and buy stock and buy more stock because, oh, they're beating earnings rates. But let's look at it in the context of the overall market. It's historically very high. Now, does that mean it can't stay high forever? Some people think it can. I might change my position after a few more years of this. History still always comes back to haunt us. And that's usually when we kind of give up on the fact that, they keep saying this time it's different, this time it's different. And then it ends up not being different after a couple of years of waiting for it to kind of stay the way it is. And it always goes back. And that's what John Templeton was famous for saying, is the most dangerous words in investing is this time it's different. And honestly, it does look a little bit different because the market's resilient, more resilient than it's been in the face of a lot of different things. I think the money printing, just the fact that the money supply has grown so big and that the wealthy have gotten so rich, they don't know what else to do with their money. Real estate's kind of topping out, so maybe that money's coming into the market and propping up stocks. Banks are playing games with the Fed and buying their own stock up. And if institutional stocks look healthy, then the market looks healthy. But it's all fake because banks are losing more money on loan defaults than they've ever loaned. People are borrowing more money on credit cards and loans, even though banks won't loan money, than has ever happened. Savings is net loss, not net growth, for almost a year now. So, economically, it doesn't look like we're going the right direction, but the market still seems to be knocking at the door of that all-time high. And again, if the market was continually going up, it would make an all-time high every day, right? If it's going up every day, but it hasn't gone up for 7 months. So they're getting all this frenzy. Oh my gosh, the market's breaking out. A few months ago, we had that discussion about the death cross where the market moved below the 50-day moving average and the 200-day moving average crossed. And that typically means it's going to go down. And it did. We had a good, nice correction in April. And then they said, oh, we're putting tariffs on hold. And that made the market happy. And it kind of bounced back. Now, the market bounced back up above its 200-day moving average, which is a level of support that was pretty important from a technical standpoint or from a confidence standpoint. And we get above that level, it now becomes a support level. But again, it can go back below it as soon as there's a sell-off or a reason to do so. And it might just be rational thinking, or it might just be people getting tired of an overvalued stock market that really hasn't done anything in 7 months. They're tired of riding the roller coaster. The market finally got back to what it was when they should have sold in December and just gone into something paying 5 or 6% and gone to safely till the next correction or recession happens, which probably is still overdue. A lot of the smart money is doing that. If you look at Warren Buffett, he's still net selling. If you look at his, they have to report their records of buys and sells, especially as an institution. I do even as a personal trader. Everybody in the business has to report. So in his public record, we know what they're buying, and we know Warren Buffett, and hundreds of other big time hedge fund managers are selling more than they're buying. And we're finally seeing the bond market starting to solidify a little bit. Bond market's been going down, which has made interest rates go up, even though the Fed says, oh, we're going to lower them. But the Fed only lowers the short-term overnight interest rate. They're not lowering 10-year bond rates. They're not lowering anything. The bond market takes care of that. And the bond market, the Fed tries to manipulate the bond market. They've not been able to do that. So if people are starting to get a little bit wary of the market, where do they put their money? Typically in bonds. And if bonds start going up, then we know on a net basis, some of the institutions, pension funds and other things are getting a little bit weak or weak-kneed about the market, and they want to go at least hedge a little bit with safety. So we've been seeing the 10-year and the 20-year bonds start creeping up in value, which means the interest rates are actually going down just a teeny bit. So that's kind of where we're at with the market and bond market. I think the smart money is seeing that the market's a little top heavy. I think the not so smart money, or the typical investor that watches TV and listens to the blowhards on, in the media that don't really know anything, are getting influenced a little bit the other way. So we'll see how it all shakes out. We say, if you're not going to need the money soon, keep it safe and don't worry about it. If you don't need the money for a long time, let's invest in the market and do well. I mean, our growth portfolio's done extremely well this year compared to the market. It did horrible in March and April like everything else, but there's good opportunities in the market if you have the stomach for it. But I don't want to do that with people's money who's paying their bills with it, because next month might be another April. Who knows what's going to happen? The fact is, you can't bet your income and your retirement lifestyle on stuff you can't control. And the market is one thing you just can't control.
Our show's called Premier Retirement. We're talking with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. Once again, if anything resonates with you, you're listening to Jeff every week talk about the market and the economy, geopolitical world events, and how they affect you, our markets here, and your retirement. Give us a call here at Premier Retirement. Request your Premier Retirement roadmap. Absolutely no cost, no obligation, no judgment for that. The number for you to call to request it, 520-780-9059. You can go ahead and make that call this weekend if you want. You can call right now. Leave your name, telephone number. Shelley will pick it up on Monday, give you a call back, and set up a time that's convenient for you and Jeff to talk. Again, there's no cost, no obligation for this. 520-780-9059 is our telephone number. We'd love to talk to you. You can also find out more about us online at premret.com, premret.com. Jeff, let's talk about the rate cuts. I believe it was last Wednesday or so. Fed Chair Powell says we're going to hold steady for right now. Some of the Fed governors are telling Donald Trump, if I were the Fed chair, I'd probably lower interest rates because they know that Fed Chair Powell's probably going to be out here pretty soon. They want that job. But cooling inflation and dovish commentary from the Fed leaders suggest a potential 2 to 3 rate cuts by the year's end. Do you think that we're going to have to wait too much longer for the first rate cut? And do you really think that, considering the history that we've had with Fed Chair Powell, that we're going to have 2 to 3 rate cuts this year?
I don't think it really matters to the economy if it does. It just matters to the psyche of the investor, because investors think that, interest rates are coming down. That means businesses don't have to pay as much for loans and stuff. That's not true. The bond market affects loans. I mean, just look what's happened to the mortgage market. Mortgage rates have been going up several basis points since Chairman Powell lowered interest rates, a little less than a year ago. So, what does that mean? Well, bond market and the interest rate that he lowers is really just a short-term interest rate. It only affects like short-term bonds. It'll affect money market rates. It'll affect what banks want to give to you on a CD for 3 months or whatever. But it's not going to necessarily, just because he says, I'm going to drop interest rates 0.5%, that doesn't mean your mortgage rate just went down 0.5%. Mortgage rates might go down 2%. You know why? Because the bond market, if people start buying bonds and the price of bonds go up, meaning people are willing to take less and less of a return on their money in order to keep it safe, to lock in all these crazy profits that they've been able to make in the stock market, which has been overvalued for a really long time. You never get hurt taking a profit. You want to get out when it's high. And a lot of the smart money is. So we're finally seeing the bond market starting to turn a corner and go up. That's going to lower interest rates. So I think the Fed saying, I don't want to lower interest rates, they don't need to lower short-term interest rates. I mean, if they do, I don't know, it just makes it easier for banks probably. It creates a little bit liquidity situation. I think that just really affects what banks borrow money for on the overnight rate and what money markets do on a short term. So I think if he leaves them up, it actually helps the typical saver, especially the people that are staying out of the market, that want short-term interest rates, want to keep liquid so that if the market does correct, or if they need money to pay some of their bills or go on a trip, they can take it out without a loss. Those people are loving the fact that short-term interest rates are higher, because that's typically what we would have our safe bank alternative money in as far as the investment side goes. So I don't think we should be chomping at the bit for him to lower rates necessarily. If the economy is not working very well, then the government kind of has to lower interest rates just to get some of that money flowing into businesses. But, if they think the economy is buzzing along, they don't need to lower interest rates. And if they lower interest rates, typically that's a signal that we're throwing in the towel here. We got to lower interest rates because otherwise the economy can't sustain itself based on current situation. And that's typically what happens is a couple of interest rates precede the next market correction. And we've been kind of on the end of that yield curve inversion and uninversion, and it kind of inverted, uninverted. It's kind of hanging in that place where long-term interest is finally going up higher than short-term interest. And it's finally looks like it's holding out there. Usually within, a quarter to 2 quarters, we have that recession. And that inversion, believe it was January or February when it finally inverted and stayed uninverted, I should say. And a lot of that was just because of the move of the bond market, being that the bonds started selling off and interest rates actually started going up because people wanted more interest, because the market looked healthy and Trump coming in had great promise to fix a lot of the economic woes that we were having that hadn't supported the market, but finally, hopefully will and would. So you got this situation with the Fed kind of in a rock and a hard place. I think Powell knows that when you start lowering interest rates and you do them too fast, it really is kind of a move to say, okay, the economy really isn't as good as we've said. And that typically makes more smart money run for the doors, which would again make money from the market likely go into bonds, which would raise the price of the bonds and drop the interest rate on those bonds. So that's another way to get interest rates down where people can start affording houses again and doing the things that we used to be able to do on lower interest rates and get the things humming again. Then again, banks like high interest rates, but maybe they can make it back on the fact that they can loan more money out because more people will be in a position where they could use it, financing for things. So again, it's kind of a catch-22. You want to lower interest rates. I think the market likes it, but in reality, the economy kind of likes a healthy interest rate. I don't know that we're so high it's unhealthy. Yeah, we're high. It's great for savers. Finally, people can make money on their bank accounts. I mean, it's great for retirees that want to keep money safe. And I would hate to see that aspect of it go away. But I also want to see enough things, maybe with some of the tax cuts, maybe some of the tariffs, some of the manufacturing coming back to America, maybe, the fact that people can get paid more for jobs and afford more things, have the economy built on that basis where people are willing to pay a few percent for a loan and they can afford it because the economy's moving, not that interest rates have to be near zero in order to even make the economy fluctuate. That was a very unhealthy situation. As much as people are, look at all the stuff we can buy. We don't pay anything for money. Yeah, but look where it got us. It got us into an inflationary period. Everything's overvalued. And now there's a disconnect between reality, and what used to happen as what happens now. It just put everybody in, kind of jaded us in a way that I think we need to come back to a little step of reality and find a healthy place for interest rates where banks and lenders can make money, where people realize that the value of money is something, but maybe they'll invest more wisely. They'll make a little bit more money on savings so that they can spend more money and the economy can grow. And with that manufacturing surge that I think we're seeing, at least seeing being promised us by all the countries that are moving manufacturing facilities back to the U.S. That have moved out, or just moving here in the first place because they want to save money on tariffs that are going forward. So either way, we either get the manufacturing or we get the tariffs, and that does help our deficit. It helps our national debt. It helps our economy, helps our wages. It helps everybody top to bottom.
Jeff, early in the program, you referred to the electronic media pundits as blowhards. I think affectionately there. Many of them have said the outlook for the rest of 2025, according to them, continued rally into the year in 8 to 12% upside, S&P 6,600 to 6,800, driven by sustained technical growth, earnings growth, Fed easing, and stable global conditions. I don't know about the stable global conditions. What's your opinion on that? What do you think the outlook is for the rest of 2025?
Well, if, that ceasefire worked, and that certainly is going to help global position. I think it's funny that Russia came and says, hey, how can we help you with Iran? And it was like, what? Why don't you help yourself with yourself? We got other crap your fingers are in, just like settle down. There's still enough political unrest to worry about. But I think the big one, the World War III one, is at least put on the shelf for now. I hope. Some of this other stuff doesn't continue to materialize. But, when we're seeing a threat of nuclear bombs and stuff and threats that somebody's going to use them within a matter of weeks, we got to turn that off. We got to turn that light switch off, and we did. So I think there's going to be a sense of, calm now. We've already seen oil continue to go down, even though it went down while they were fighting. Yeah. But it's still kind of softening up a little bit, which is good. We realize that we're in a much better place there. I don't think just oil costs going down is going to necessarily make the market go up. I think it'll make profits be more in line with what should be happening with the price earnings ratios. They're presenting that they're going to be so much better next year than they are now. There needs to be earnings, and low oil prices certainly does help with transportation costs, and that affects every business. Helps the household save money and buy more things. So I could see the economy booming just on that alone. We've already seen the tariffs raise tons of extra money that support the tax cuts that everybody was complaining about. Oh my gosh, too much tax cuts, too much going out, nothing coming in. No, there's a lot coming in. And Trump's strategies, I think, are well thought out. And we're finding out that they're maybe even better than we had hoped, or at least they're in line with what he had hoped. I mean, he had super high expectations. I thought, well, maybe he's shooting for the moon and hope we get to the treetops. Either way, we're higher than we were when we started. But I think I'm getting very hopeful looking at what's happening. I don't know how it will play out in the market because I still think the overvaluation is going to be there. There's still economic cycles that typically do that so far have always completed and they haven't yet. I'm still riding that horse. Yes, I am. And more, not from a standpoint that we're not in the market because we do have a growth fund that's making money, but it should be taken with a lot of respect for the risk that's out there, given history, given the cycles that we're in. And honestly, the type of upside forecast from right now being around 6,700, that's about a 10% upside gain. Deutsche Bank said it was going to be 10 to 12% and get up to 6,550. They must have said that when market was like 57, 5,800 then. But it's in the 6,000 range on the S&P right now. So is it going to beat that high and stay above it? Is it going to knock at the door of the high and then fall? That's typically what happens when you hit certain levels of resistance, and the old high is a level of resistance. And so let's just see how it plays out. You know, it touches there, it might touch above it and bounce around for a little bit. And even if it goes up for a couple of days, it may be also the signal for some of the big players in the market to have one last exit before what they've considered being inevitable, and that was a recession. You know, that's been called for since about the third quarter of last year, and then it was put off another quarter. And now they're talking about third quarter of this year being the time frame. We're still in the second quarter right now for a few more days and starting the third quarter. So you never know. Summertime is usually kind of a weak time. We might see a little bit of weakening. We also, interestingly, we saw Bank of America, who also raised their forecasts just recently. They said that the market was already top heavy at about 5,800, and they thought it would end the year, I think it was like 5,500 or so. So it was already kind of where it would be, and there was going to be no gains. This was only like a month ago. So what's changed then? Well, I don't know, because we evaded World War III and all of a sudden everybody got happy, or are there really that much economic changes happening with tariffs, the fact that it's not crashing the economy, and maybe people are getting a little bit more excited about the future. So hopefully we'll get there. I think a little bit of upside is great to forecast. I wouldn't bet your life or your retirement on it. I would bet the risk money that you like to keep in risk and try to make some of that 10 or 12% that Deutsche Bank thinks we're going to make, or the 5 to 10% that BMO, Goldman Sachs, and Bank of America think that we might make throughout the end of the year. Bottom line is only risk the money that you can afford to lose, because you never know the market. The market does what it wants when it wants to, not always when we think it will.
Talking with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. Our program, of course, called Premier Retirement. And if you would like to talk to Jeff about your individual situation, maybe how the geopolitical events might affect you, the market, and your journey towards a confident retirement, again, we're offering no cost, no obligation for our retirement roadmap. 520-780-9059 is our telephone number. You can make that call right now if you want. Leave your name, telephone number. Shelley will call you back. Set up a time for you to come and sit down with Jeff. Talk about your individual situation. We can talk about anything. We're not a limited scope advisor here at Premier Retirement. We've got a very deep toolbox, and of course, we are a fiduciary. 520-780-9059. You can also find out more about us online, of course, at premret.com. Jeff, let's take a break. We come back here on Premier Retirement. We're going to be answering some listener questions and more when our program continues on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shade.
Thank you so much for making us a part of your weekend. You're listening to Premier Retirement with Jeff Hogan, founder and president of Premier Retirement Planning and Wealth Management in Tucson and Mesa. My name is Jeff Shade, and we're here for you on the radio 4 times a week in the broadcast radio, 790 KNST, Saturdays at 7 a.m., also 9 a.m. and 1 p.m., We're also on Sundays at 11 a.m. If those times are not convenient for you, or maybe you don't have a chance to hear the entire show, we're also a podcast. Go to wherever you get your podcast, search for Premier Retirement with Jeff Hogan. You'll find this show and all of our past shows so you can stay on top of understanding current events in your journey towards a prosperous retirement. If all that's a little too complex, simply Google Premier Retirement with Jeff Hogan. It'll point you in the right direction. 520-780-9059 is our telephone number. If you'd like to get in, sit down, and talk to Jeff, we'd love to hear from you. No cost and no obligation for that. All right, Jeff, time for listener questions. First one's Tom listening to us in Tucson, and Tom says, when I leave my job, would I be better off taking a $61,000 lump sum to roll over into an existing IRA, or instead take $355 a month for life? I'm 49. I have no debt except for a mortgage with $56,000 left. I'm currently working full-time and receiving $2,400 per month military pension. My current net worth, assets minus liabilities, $350,000. My S&P investments have roughly doubled every 7 years. What should I do? A lot of questions there, Jeff.
Well, if you leave your job and you take a lump sum on the rollover into an existing IRA, that's a non-taxable benefit. You now become the owner of the money. You can use it when you want, how you want. You can also use annuities that keep it in your control, but they would still pay you approximately that $355 a month for life, and you'd still have access to the cash. You die or you want to cash it in after 10 or 15 years, you want to just go on a trip or buy a motorhome with it, you can do that. When you annuitize with the employer, you won't be able to do that. So I'm definitely a proponent of moving any existing money that you can do a lump sum. I mean, if they would pay you $600 a month for life, that would be maybe a more compelling argument, because that's your break even's 8 years. That's going to be hard to beat, and you're only 49. So the other thing I don't know is this 61,000 lump sum based on age 55 retirement, age 59, 65, what? Or is this right now? If it's right now, obviously the fact that you're going to live a long time is why they're only giving you $355 a month, because that's going to take about 15 years to break even. Everything else is gravy. That's actually not a bad deal. But believe it or not, some insurance companies may be able to do better for you. And that's, by the way, what they're doing is basically handing it over to a custodian like an insurance company. And in many cases, it is an insurance company. It might even be the same one I could give you an annuity with. So depending on where you're working and what the options are, I would definitely look at the options. I need a little bit more information to decide, or just let the math decide what makes the most sense. I don't know when you're leaving your job. Is it you're 49 now? I'm just guessing you're not leaving your job right now. $56,000 mortgage. If you're working full-time and receiving your monthly pension, it seems to me like you probably pay that mortgage off in the next few years. If you kept working for a little bit and just paying that down quickly, you'd be able to retire mortgage-free if that's what you want to. Your S&P investments have roughly doubled every 7 years, and they probably will average that over the long period of time. The $350,000, if you need to start using it for income, you may consider what you're making full time and maybe take some of that $350 off. Maybe you need $2,000 a month in addition to the $2,000 you're making from your military pension. Maybe that requires $250 of that $350 in some sort of an additional pension plan to lump. Maybe you take the $61,000 and maybe $200 of the $350, and you end up with $2,000 a month instead of $400 or $500 a month. So then if you can live on $4,000 or $5,000 a month, then you can invest the other $150 as aggressive as you want. You don't have to use it. And if the market continues to double every 7 years, great. Your $150 gets back to $300, 10 more years, it's up to $600 and $1 million by the time you have to take, your RMDs out if you don't have to touch it. But the thing is you don't want to put all your money in the market and need to use $2,000 a month off of that $350 and not be able to take it because the market crashes 50% and takes another 10 years before it gets back to even. We could go into another lost decade like the 2000 to 2010 era where nobody really made any money, but they ended up losing more than what they spent because they kept locking in losses while they had to pull money out to live on. So again, it depends on what your retirement date is. Depends how much that 350 can grow to between now and then. If you're going to retire next year, it's a different story than if you're going to retire 10 years from now. If you're going to retire 10 years from now, you could maneuver less of that $350,000 to still make up the difference in that income because companies pay you more the longer you wait to take income. The stock market also will probably make more the longer you don't have to take money out in a volatile market. So there's a lot more to this question that I would need to know before we could make a plan, but hopefully I gave you enough information at least to start thinking of the right questions. I think the biggest point of retirement planning is knowing what questions to ask. And maybe I gave you a few here. You asked some of the questions already that were pretty logical, but there's a lot more things that I need to know before I could probably advise you correctly or in a more responsible way. Meantime, at 49, you've got a good start to your savings. You've got a nice pension. That pension, by the way, is worth another $500,000. If you had it in a 401k and didn't have the pension, you'd need to be at about $850,000 or $900,000 now to have the same type of income. Nice part is that $2,400 a month military pension is not going away. So good for you. Thank you for your service in that. And I wish you the best. If you want to come in and do the math on the rest of the plan, show me the rest of the numbers. I think you'll probably get, if nothing else, you get a much higher level of confidence going into your retirement that it'll be okay when you do decide to pull that plug.
Tom, thanks for listening to us. And of course, Jeff's number, 520-780-9059. As Jeff said, there may be a few things that you didn't mention in this that would determine what is the best path for you. But I think really no cost, no obligation to come in and see Jeff is going to be a pretty good move for you. 520-780-9059. Call and make that appointment. Shelley will find a time for you. Okay, Jeff, let's go to Bill in Casa Grande. Bill writes, I inherited an IRA from my mother who was already taking RMDs when she passed away. Am I required to take RMDs from the inherited IRA, or does the IRA simply need to be depleted by 10 years from the date of inheritance? I don't have any special needs or disabilities. Similarly, are RMDs required from the Roth IRA I inherited, or does it simply need to be depleted within 10 years from the date of inheritance?
Well, a lot of this depends on when you inherited it. I'm guessing you recently inherited it. The laws changed with the Secure Act of 20 and 21, and for a long time, there's a lot of confusion. Honestly, there's probably still going to be a lot of confusion when these 10-year periods run out and people didn't take their money or didn't continue to take required minimum distributions. Depending on whether your mom was already taking minimum distributions, if they were already in minimum distribution mode, you have to continue to do that based on your life expectancy, which means they go down, or based on hers, depending on when she took it, how old she was, and if it was a pre-2020 event or not. So depending on what that is, the balance of it would have to be taken at the end of that 10-year period, however. And that applies, in my understanding, to all IRAs, even if they were pre-2020. So you can keep taking the RMDs until the last lump sum. Now, keep in mind that it's all taxable when it comes out. So you might want to basically amortize it over 10 equal payments or however many years are left on that IRA, just so you can manage your tax bill better. You can't move it to your own IRA. You have to actually pay taxes on it and put it into some non-qualified account, non-IRA account. Some of my clients that are still young and healthy will take inherited IRAs and they'll just deplete that money in the next 5 years and put it into something like a LIRP, life insurance retirement plan, in their name. And that way that money continues to grow tax-free. But you can do it on your terms, know exactly what taxes you're paying on the IRA distribution. And I'm assuming maybe you're not old enough to take your own IRA money out. Might be good to get that inherited IRA off the table as far as a future tax problem, especially if within the next 10 years, you're going to have to start taking IRA distributions out of your own IRAs because you'll be 73 years old or so at that time. It takes us about an hour to get to know you well enough to know all the answers that I would probably give you as far as a recommendation goes. But you gave me a good start. The fact is there are some differing situations. How old your mom was she taking the RMDs? How old you are? What is your required minimum distributions going to look like? What are your retirement income plans? And is any of this going to cause you to be jumped into a higher tax bracket for either a short period of time or a long period of time? I'd rather take a higher tax bracket for a one-time event or a short period of time than a long period of time. So you have to look at the whole picture. And that's why when we build an income plan, it's on a spreadsheet that goes out 20, 30, 40 years until you're age 100 or more. I had the first one tell me, can you run that longer? I said, well, sure. Why? And he said, well, I don't know. I just feel like I'm going to live past 100. I said, well, good for you. Yeah, they're like in their early 70s now, and they look good, by the way. But the thing is we have to see what the ramifications of what you do today do to the future. And that's why we put the whole plan together. And that inherited IRA, it might be just one of those, if it's small enough, you just take the whole thing out and just use it for something. If it doesn't push you into a higher tax bracket, if you're already in the 22 bracket, you're going to want to stay in the 22 bracket, for example. Well, maybe you've got $100,000 income, but you can have another $100,000 in income. You're still in the 22 bracket. If you're going to always be in the 22% or the 25% tax bracket, you might as well just lump sum that thing out and move it to where you want and never pay taxes again. So I believe in just paying taxes, paying the least amount of taxes on the least amount of money. And that's one way to do it. As far as your Roth inherited IRA, you don't have to take any distributions regardless of when you inherited it. However, the 10-year situation does apply. And honestly, the RMDs, since the RMDs aren't required, but the 10-year distribution rule is applicable, that's one of those things that can continue to go tax-free. And in my opinion, that's what you leave in there for the whole 10 years. You take it out on 9 years and 364 days and you're good. So yeah, if you can put in something that's guaranteed growth, good for you. Again, it depends on your overall situation. There may be some needs that might be nice to have some tax-free income right now to pay off maybe some high-interest debt or something like that, and you're in a high tax bracket, and rather use Roth money than deplete the entire IRAs because the RMDs on that inherited IRA are much less at this point. So again, way too much other factors need to be considered before I can give you your final answer, but come in and talk. We can drill down a little bit deeper. Hopefully what I gave you helps you, at least get you to first base. If you want to get all the way around the bases, come on in.
Bill, thanks for that question, and thanks for listening to us in Casa Grande. Some people say Casa Grande, but I like to go with the Spanish pronunciation. It's the big house, Casa Grande. We'll, of course, send you out Jeff's book, Retirement: The Road Ahead. And again, we appreciate you listening to us. Let us go now to Allison, Jeff, listening to us in Green Valley. Allison says, I'm interested in converting a traditional IRA into a Roth IRA, and I want to know if the taxes are due at the time of the rollover. Currently, I have $95,566 in a traditional IRA and would like to roll over $60,000 to a Roth IRA. Also, is it possible to have part of the taxes designated as a qualified charitable distribution to a not-for-profit church?
You could do that you could do the charitable qualified distribution if you're over age 70. I didn't see your age on the question here. If you're over age 70, you can do the qualified charitable contribution, and that just gets rid of that money coming into your account as income. Now, the Roth IRA income is not going to count as income anyway, but if you wanted to give your $95,000 to the charity, all that does is offset the distribution from your traditional IRA. It does not, it's a tax deduction off your tax returns. The Roth IRA doesn't have a tax ramification other than the fact that it's considered non-taxable income. So I don't think what you're trying to accomplish the way I'm reading this question is going to work. However, I do have a tax tip for you and everybody else who does conversions with IRAs into Roths. And that is, I think it's foolish if you're in May or any time earlier than December, if you roll money from an IRA to a Roth and have 20 or 30% withheld from that rollover, and you give it to the IRS to hold on to and make money on it, and you not make money on it, is foolish. Some people say, well, yeah, but if I don't withhold, then I'm going to get penalized. Okay, we'll address that in a second. Or, well, aren't I supposed to make quarterlies on it? I have to make my quarterly withholdings. Honestly, if you have income and don't withhold, or if you don't make your quarterlies, the IRS actually does know about that. But when you take money out of an IRA, they don't get that final notification till the end of the year. You can have withholdings anytime. In other words, you can roll the 60 out right now in June and continue to make money on the other 35, 36,000 that's in the IRA till the end of the year. And December 25th or 26th, just come right after Christmas, you can have $20,000 or whatever your tax bill is going to be. Maybe it's, let's say $15,000. Let's say you're in about a 25% tax bracket. You take your $12,000 or $15,000 out of your IRA and just have it 100% withholdings. That way, the government sees that you took out a total of that $72,000 or $75,000. You withhold 15 of it, and the $60,000 that already rolled to your Roth is already covered. So again, that way you got to make money on that $15,000 in taxes for half a year. And even if it is only, in a low interest account, you're still making $350, $400 extra, and every little penny counts, in my opinion. So you don't have to take the RMDs or the withholdings when you move the RMD. You just have to do it by the end of the year if you don't want to be penalized or hit with interest.
Adelson, again, good question. Thank you so much for listening to us in Green Valley. We'll send you out Jeff's book, Retirement: The Road Ahead. If you have a question for us you'd like us to answer on the air, you can get it to us two ways. One of which is to call it in to Shelley at 520-780-9059. You can also go out to the website, premret.com. Use the contact page. If we use it on the air, you'll not only get a good, snappy answer, but you'll also get Jeff's book, Retirement: The Road Ahead. You can also use that number, 520-780-9059, to request your no-cost, no-obligation, no-judgment retirement roadmap review with Jeff. Again, it's not going to cost you a dime. 520-780-9059, and of course online at premret.com. Jeff, let's move on to our last segment here, estate planning for the great wealth transfer. Protect your legacy and not Uncle Sam's. Jeff, what exactly is that, and why should our listeners really care about it at all?
Well, I don't know that the listeners really care that $80 trillion is going to pass from baby boomers to Gen X. They really only probably need to care about what they're passing of that portion, in my opinion. Now, for our industry, it is a big deal because on $80 trillion passing, man, if the government can tax the heck out of that with IRA distributions that haven't been made that are taxed on death or within that 10 years after death, on estate taxes, if your estate is more than, well, right now it's tens of millions, but what if they drop the estate tax level down to $1 million or $4 million, what they're talking about? Even if you have $1 million or $2 million now in net worth, it could easily be worth double or triple that by the time you pass away. The baby boomers, we're looking at the next 20, 30 years that they're going to be passing away and passing on large estates. That was the earnings of that generation were pretty significant. And if you look at the fact that most of them are pretty self-sufficient in retirement without having to use their savings, there might be some huge estates. which means the government on an estate tax basis gets almost 50% of every dollar over and above whatever the unified credit allows, which is the amount that isn't estate taxed. The other thing is everything that hasn't been taxed, that's on a deferred basis, gets taxed, unless it gets a step up in basis like real estate and some stocks and things that have been held for a long time. And that step up in basis might even go away. So from our standpoint, that's a lot of money and a lot of taxes that would go to the government. Now, does that help our deficits? I wish I could say it would. Here's what it'll really help. The government would just find more ways to spend all that money and keep leaving us in the lurch, so to speak. So my opinion is my job as an estate planner is to help people keep their money. It's your money, keep it that way. That's our slogan in our company. It's your money, keep it that way. Don't send it to the government. They just throw it down the black hole or find some way to spend it or give it away to their cronies or to some other cause that you don't care about. If I can help you keep that tax money in your pocket and in your family and in the community where I live and work, then the world is a better place, in my opinion. And that's why last year, some people say, wow, you guys, your portfolio beat the market by 5 or 6%. Wow, that's really good. But do we care about that as much as the fact that our plans show people how to save almost $300 million in taxes? I mean, that's a lot of millions in taxes if you plan right and you look at the difference in what you would have paid if you don't do a plan and what you'd pay if you do a plan. That's the significance of where our planning makes the most sense, is not just, oh, are you going to beat the market by a 1 or 2% so I can cover my fees, or is my money going to be better? No, it's the overall fact that you're going to have more money in the end because you didn't leave it out there for the government to grab, not just while you were alive, but also when you die. So very important, a lot of money going to be taxed. If you can solve that problem now, the sooner you start, the sooner you move that money from tax now or tax in the future to never taxed money, the cheaper it's going to be for you and the more money you'll keep in your family. And it also might make you in a position where you don't have to take a ton of risk out there in the stock market or things that will make your gut hurt when it goes up and down. You can put your money in a lot more safe strategies, worry less, because you're making more on tax savings than you would have on the extra money you might have made in the market if it did well. So again, a couple of perspectives, and those are the reasons that I think that $80 trillion passing from baby boomers is important, because that's really our focus. That's our market. That's who we serve. And most people who come in here do have a tax problem, whether they know it or not. And it might be a tax problem they see now. It might be a tax problem they wouldn't see until in the future, but that's our job. We have that crystal ball. We don't really have a crystal ball on some stuff, but we do have a crystal ball knowing you're in a position where you're going to pay more taxes in the future. That's pretty obvious. You don't really need a crystal ball for that. If you have a little bit of knowledge about how life and money works, we might be able to help steer that, navigate you through those tax waters in a more successful and more safe way.
Jeff, what are some of the most common estate planning mistakes that you've seen people make in your practice?
On the estate planning mistakes, I'll just say beneficiary designations are a big one. Probably the biggest one is thinking that a will is actually the thing you need to keep you out of probate. That's probably the biggest one. Or just naming, and here's what's interesting, people that do life insurance and even set up IRAs at banks and different institutions, they already disclaim on all their papers and disclosures that they don't give tax or legal advice. In other words, they don't even have to know anything about what to do on your documents as far as beneficiary issues go. If they leave it blank, or if they put estate, that means that asset will go through probate before your kids or loved ones get any of that money. Make sure your beneficiary designations are set up. So a will could be one of those costly mistakes because it shoots you through probate. I don't like having a will. We put wills in our trust packages and give them as a backup document just in case you need it. But it's one of those things we want you to have and not need rather than need and not have. There are some cases where somebody forgets to do something and has to open a probate case just to appease the court that everything was taken care of and the rightful beneficiaries were served the way that they needed to be. But not having a plan at all, or just putting it off because nobody wants to think about dying or their demise, they just don't do anything. A failed plan is a plan to fail. We know that, and that's really what happens. A lot of people have outdated documents. Some people think, yeah, but I have a trust. I've had it forever, and it works just fine. Well, maybe it does. If you got that trust in Georgia, and it has Georgia powers of attorney that were done back in the 90s, and you think, well, the trust works in all states. Well, it does, but what about the HIPAA disclosures that you now need in order for anybody to know about your health care on your powers of attorney? Some doctors, in fact, most, if it's a document that was done in another state and it may not comply to Arizona laws, they don't have to accept it. If that trust or that document lives in another state and doesn't have the ability to basically conform to the laws of Arizona, if that language isn't in there, you might be surprised that it doesn't work here. So a lot of people in Arizona from other states, you have to make sure that the documents are updated and make sure that they're current. That doesn't always happen probably as often as most lawyers would love you to think they need to be updated, because that's, of course, how they make their living. By the way, we do trust. We have the document preparers that we use actually work for the attorneys, but they do the same trust for us that they would do to the attorneys. If you want to work with us direct, we can send you to the attorney and pay more, or we can just use the same documents and the same services, for a pretty discounted price from what most people do. Sometimes people forget to take ex-spouses off as beneficiaries. Some people forget to add kids if they name them directly. They have a few more grandkids and they forgot to put them on. That's one of those things that you can't really change. Once you're gone, it's done, and you could leave a big old mess for your heirs if you're not vigilant in those areas.
Jeff, I think the biggest piece of advice that we can give to our listeners today, for someone listening to the show right now who hasn't started estate planning or hasn't looked at it in years, don't wait. Estate planning isn't just for the ultra wealthy. If you own a home, you've got retirement accounts, or you care about how your family's affected, you need a plan. So we want you to start with our review of your existing documents. We're going to help you update your beneficiaries, and we invite you to give us a call here. Jeff Bogan at Premier Retirement, a trusted financial advisor who is well-versed in estate planning. 520-780-9059 is our telephone number. If you've got questions about estate planning, we'd love to talk to you. 520-780-9059. There's absolutely no cost, no obligation. It's part of our retirement roadmap. And again, it's not going to cost you a dime. 520-780-9059. Make that call right now. Leave your name, telephone number. Shelley will call you back during the week. You can also find out more about us online at primrat.com. Jeff, out of time for this week. Thanks so much for your time. Most importantly, I want to thank our great listeners for joining us here in the greater Tucson area. So for Jeff Bogan, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage, Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.